You have to do is listen and believe them. Now, he keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. The recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 2000 bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is, important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub, and you got three Irish storytellers, and I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. And Jay Powell is probably sick. He's given 6 speeches, either post-FOMC meeting press conferences or like the Brookings Institution speech at the end of November, Jackson Hole, August 26th. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said, we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said, unemployment is going to go up. And the Jackson Hole speech, he used the word pain, like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said, there's going to be a lot of pain. You're going to feel the pain. But the point is, he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is that the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes. That's the definition. So what's that number? And the Fed thinks it's 5.25. The market somehow thinks it's like 4.75, which we just got to, or maybe 5, but it's most likely 5.25, possibly higher, but I'll settle on 5.25. The Fed's not there yet. They're going to have to raise another 25 basis points in March 22nd. That's next FOMC, and again in early May. That those 2 additional 25 basis point rate hikes, in addition to what we've just seen, will get you to 5.25. And then from there, you go to the pause, and they use the word pause. And Powell's like, that could last a year, and maybe early mid 2024, we're looking at rate cuts. But we've got to get inflation under control. Let's go to our next Irish storyteller. This is the market, and in particular, although here we probably have to distinguish between the stock market and the bond market. Bond market's a lot smarter. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo, that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March, maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. So this is the soft landing Goldilocks, wrong fairy tale. This is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. Yeah. The bond market is telling a completely different story, by the way, and this is a little more esoteric. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. And bunds have never been averted. They are now. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a a big red siren, a flashing light, whatever you want to call it. Interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They're going to make it worse. They're going to make the recession even worse. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So right now they're going down, but we had a recent rally, but this is the third one. We had a rally in July and early August. We had another rally in October, but they both corrected. The August rally corrected in September. The October rally corrected in November and December. And this January rally is going to correct also, maybe hard. But the Fed, again, that's not enough to get the Fed to act, but a so-called disorderly crash will. But that may happen. In fact, I expect it will, but we're not there yet. In late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. And so I agree with the market that we're going to get a pivot, but I completely disagree. In my fairy tale, Little Red Riding Hood gets eaten by the wolf. Just to expand, not only do I agree with that, but I think the bottom could be a lot lower than most. Even the people say recession, little correction, I think it's going to be worse. So the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the NASDAQ, the turnaround actually started in November 2021. So we're down from those levels. We've kind of maybe reached some moving average, but we're nowhere near the old highs. But that it could easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 2,000, 2,100, something like that.